Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for September 19th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and very special guest, Dustin Jalbert. Good morning, gentlemen.
Good morning, Ken.
Good morning.
Thanks for coming back on, Justin. It was a great conversation last time, so we're thrilled to have you back.
Yeah, it's a pleasure to be here. It's always fun to talk housing and the wood products market. So thanks for having me again.
Before we get there, a question we ask every guest. Do you have any college football allegiances? Because that really is the most important topic.
Look, this is a little embarrassing, but I'm from the Northeast, so not much college football in my life, mostly just the national sports teams. I'm pretty much a New England guy across the board for the national sports team. So sorry.
Patriots fan
there. Yeah, my primary sports, I'm probably mostly hockey and baseball, but I definitely am a fair weather Patriots fan is the way I describe it. So yeah.
I get it. My first allegiance professionally is the Pittsburgh Penguins. I was born and raised in the Pittsburgh area, so I'm a Pittsburgh professional sports team, but I grew up with the Lemieux, Yager years, Tom Barrasso. So those were great teams to.
They were okay. Yeah, they were okay. Those teams, right? Yeah. So
not bad. Not bad. Dustin, do you mind giving folks a little reintroduction for those who may not have been viewing last time you were on?
Yeah, absolutely. So again, Dustin Jalbert. I work as a senior economist with Fast Markets, and my specialty area is I cover the North American softwood lumber market, but our team covers sort of the housing market, repair and remodeling market very closely. And for those who don't know, Fast Markets, we are a price reporting agency that reports on a variety of sort of commodities, including sort of agriculture, metals, mining, forest products. And on top of our bread and butter price reporting business, we also have a team of sort of economists and analysts that do sort of demand supply, sort of market research, forecasting, that sort of thing as well in those respective verticals. So I've been working with sort of Fast Markets and Reese, which was acquired by Fast Markets for almost 10 years now. So
awesome. Well, thank you for joining us. We'll bring you back in a few minutes. We're going to hop into our market update and then bring you back on to talk about some of the things you just mentioned. So hang tight. We'll be right back. All right. So some key trends that we are, in fact, watching. I believe the technical term in economic analysis is the market is stuck pretty much across all three equipment types. Not a ton of movement. I would say not wholly unexpected right now. There's not a lot of seasonal pressure just yet. If it remains, stuck, I'd say over the next 4 or 5 weeks, then we've got more of a problem to discuss. We've got some headwinds on demand. That Michigan State truckload ton mile index down 6.6% month over month and 2.3% year over year. That index is a little bit delayed, so we're reporting on July here, just kind of to call that out. And to quote from Dr. Jason Miller, points towards a prolonged period of weak truck transportation demand would be his overall takeaway there. August single-family housing starts down 4.3% month over month, just 3% above 2019 levels. Dustin might have something to say about this, but I presume a lot of that is due to the drastically different interest rate climate that we're in today compared to 2019, but we'll ask him that in a few. August import volumes are up slightly, the highest TEU volume down this year. Volumes are still down 14% year over year compared to 2019. The West Coast are up 1% and East Coast up 5%. I suspect the East Coast would be up a little bit more if we weren't dealing with some drought issues, water level issues in Panama. But again, something we can ask Dean to explain on a little bit later. And then I think the big one, which we typically do save for last year, the UAW strike is something that should be front of mind for all folks in transportation and logistics, especially in the Midwest, and even more so if you're in that specialized big three area. Having spent many years supporting that, I would say that this is, without a doubt, the biggest thing looming in freight at this very moment. So I'm sure Dean will cover it, and we can answer your questions if you drop them below. So with that, I will turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. Let's start with the load-to-truck ratio in dry van. It's been sitting around the same level for the last 6 weeks. Load posts were up last week, still 24% lower than last year, but very consistently over the last 6 weeks, still about 4% above 2019 levels. Last week, the load-to-truck ratio down slightly to 2.95. In the refrigerated category, load posts were down 2% last week, still about 45% lower than last year. Of course, it'll be another 6 weeks before fall produce season starts to materially impact reefer truckload volumes. That typically occurs at the end of October each year, looking at USDA data. Load to truck ratio down to 3.72. And in flatbed, load post volumes continue to track at around half of what they were in 2019, to give you a sense of how flat the flatbed market is. Load posts were down about 19% last week. Carrier equipment posts up slightly. Load to truck ratio sitting at about 6.99. Having a look at some of our key market areas this week, after dropping for the prior 3 weeks, line haul rates in Los Angeles were flat at $1.71, boosted by higher import volumes in August. On the key West Coast lanes to warehouse markets like Stockton and Phoenix, the volume of loads moving were up 7% month over month and 1% month over month, respectively. Rates for carriers were Los Angeles to Stockton sitting at around $2.39 per mile last week, the lowest in 12 months, to give you a sense of how loose capacity is there. Phoenix loads at $2.81 a mile were at a 3-month average. Again, not a lot of change there. Outbound California state level rates have been decreasing steadily since the July 4 break, averaging $1.93, also identical to where they were in 2019. In Chicago and Joliet, spot rates are up for the 4th week at $2.08 and $2.12, respectively. Illinois state rates are up around 5 cents a mile higher than where they were in 2019. Having a look at the market condition index for refrigerated, again, we'll talk about the Pacific Northwest produce region as we get into fall produce. It contributed about 22% of last week's truckload volume in the Pacific Northwest compared to California's 18% of total loads. So we're seeing that shift that occurs this time of the year to the Pacific Northwest. In Washington State, volumes were 4% lower than this time last year. Outbound loads, they were averaging $1.97. In Pendleton, spot rates increased for the 4th week, paying carriers $1.88 per mile, while in nearby Twin Falls, Idaho, rates averaged $2.14 a mile. Having a look at the flatbed market, capacity in the Medford, Oregon market was very tight last week. We'll talk to Dustin about that shortly. Spot rates jumped 20 cents a mile to $2.75 outbound Medford, while loads to Stockton out of Medford averaged $3.26. That's 25 cents a mile lower than this time last year. In Fresno, loads paid $1.88 per mile. That was up 7 cents a mile last week. Regional loads to Reno were paying $2.58. And after dropping for the prior 2 weeks, capacity tightened slightly in Houston, where spot rates increased a penny per mile to an average of $2.01. On the Houston to Lubbock lane, loads destined for the Permian Basin oil field are at their lowest level in 12 months at $2.12. That's $1.27 a mile lower than last year, which is an interesting data point. We should talk about that a bit later as crude oil bumps up oil. All right, having a look at year over year, look at spot rates, starting with dry van at just over $1.60 per mile. Dry van spot rates have been around that level for the last 6 weeks, showing more definite signs of the market bottoming out or being stuck, as Ken described it earlier. Last week's national average was 25 cents a mile lower than last year and about 2 cents a mile higher than in 2019. Having a look at refrigerated at $1.97 per mile, reefer line haul spot rates, remember folks, these exclude fuel. Reefer line haul spot rates are at a 6-week national average following last week's decrease of a penny per mile. They're about 25 cents a mile lower than this time last year and 7 cents a mile higher than 2019. And in flatbed, lastly, rates were mostly flat last week, sitting at about $1.92 per mile, also identical to the 6-week average. They've dropped 22 cents a mile since the start of June. Flatbed line haul rates show signs of bottoming out, about 24 cents a mile lower than this time last year and sitting just 3 cents a mile higher than 2019. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com market update and download our weekly report, which should be posted this evening. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So just to level set, we always start with dry van on these forecasts. The blue line is the historical data. It's a 7-day weighted moving average. It excludes fuel. We go back to April 1st, 23 here, just to give y'all a viewpoint into where rates have been trending. And then we have 4 different models that we show. So we have the red, which is a short-term forecast, which more heavily weights near-term data. Green is RateCast. That's our flagship forecasting model. It's in all of our products. And then we have a yellow and a gray, which are different kind of intermediate models that straddle the two. And what you can see here is a lot more directional agreement, but still varying levels. I think Raycast is going to be a bit more optimistic in these coming weeks. There is that typical dual kind of peak that we see for peak shipping season. So things typically run up heading into Halloween, back off until Thanksgiving, and then it's all systems go until Christmas time and New Year's. I think the short-term model is wildly pessimistic here. I'd be very surprised if we saw, 10 cents of rate degradation over the next 35 days. I think that would push carriers to a lot of the points Dean just made between that and fuel. And potential volume loss with the auto strike, that would push carriers way beyond any sort of brink. I think if we see rates go up 5 to 7 cents and then come back down, that's probably more realistic. So I would tend to agree more with what Raycast is projecting here. Let's go to refrigerated. You're going to see a much tighter alignment here, much more of a down and to the right. Again, there's a little bit more latitude here to go down before we touch those previous lows that we saw in April. So all three of these models on the downside are not what I would consider outside the realm of possibility. But I do tend to agree a little bit more with the optimism that Raycast is portraying here over the next 35 days. Let's wrap it up with flatbed. These are the most in agreement by far. You see a little bit more short term, and by that I mean like 2 weeks worth of optimism on Raycast before it exactly lines up with the other models pretty much. I think there isn't as much of a natural floor to observe. I think we're going to bring Dustin back on in a minute and talk about how flatbed probably has a ways more to go before we would consider that to bottom out. It's a much more transient demand and supply pool that we see in the spot market compared with the other equipment types. But as you can see here, all four of the models that we have are pretty much all within a penny or two by the end of the forecast horizon, which seems to indicate that both short and long term are aligning on what they're seeing. So with that, we're going to not spend any more time in chart land and bring back some great discussion around some of the macroeconomic variables. Dean?
Yeah, thanks, Ken. Dustin, residential construction numbers for August were just released this morning by the US Census Bureau. Are you surprised by the 4% decrease in single-family housing starts?
Dean, it's not too much of a shock. When we look at single-family starts and multifamily in particular, but it also applies for single-family, it tends to be sort of volatile month to month. If you kind of plot single family, it kind of has more of a squiggly line while permits are a little smoother. So down, 4%, a little over 4% month over month wasn't a huge shocker. If you kind of take a 3-month rolling average or, sort of kind of smooth that out, it does still show, single family is sort of bouncing off this bottom that we saw earlier in the year from kind of this interest rate shock that we're facing. And I think what also confirms that too is when you look at the permits numbers were up, I think maybe 2% month over month, which again parses out the volatility. Some of that volatility too could be, we had extremely hot conditions in the U.S. South, all the way from sort of Texas, eastern Texas down to Florida in the month of August. So no doubt that affects builder productivity, and it was quite rainy in the rest of the U.S. too. So not too shocking. I think the story is still recovery, but maybe some deceleration in single family starts, which maybe has us a little bit concerned. So.
Yeah, that's. I was looking at the numbers this morning just briefly, Dustin, and compared to this time in 2019, which is very similar kind of freight market that we're seeing here at DAT. The number of single-family housing started in last month was only 30,000 higher than this time in 2019. Compare and contrast those 2 years for us, because we see a lot of similarities with freight demand in 2019 versus this year.
Yeah, 2019 was a challenging year for the housing and wood products markets, right? We had a, not to the same degree, but we had a significant rate shock in 20. I'd have to look back at the chart, but I think into 2018, the Fed, significantly raised interest rates, and of course, you give it 6 to 12 months, and home sales came off, and housing starts fall off, right? Especially on the single family side. Obviously, the rate shock we're facing right now is, I would have to look back historically, but it's a borderline historic sort of increase in interest rates in the period of time that we've seen. So in that sense, what is interesting, given that the amount of increase in rates we've seen, let's call it 500 basis points in 12 to 18 months, it is kind of amazing that housing starts, especially on the single family side, have been as resilient as they have, right? So I think in that sense, the levels are similar, but I mean, the degree of the exogenous shock, that being rates, is a lot bigger right now. And I think that does, say something to the health of household balance sheets and the consumer. There is a shelter shortage, to some degree. Obviously, we have a market and adjustment right now, but there is this kind of millennial cohort that wants to step into home ownership. So that is kind of what's keeping things afloat. I think the other thing too that I would add is why things are maybe a little bit more resilient now, despite the degree of the shock. Builders have been very aggressive with incentives, particularly interest rate buy downs on the mortgages. So even though the prevailing mortgage rate is something like 7 to 7.5% right now in terms of the market, what builders are offering buyers is more like 5 to 6%, which makes a big difference in terms of pulling people into making that step into home ownership. So
yeah, what I think, one of the prevailing theories that I tend to subscribe to is that the high interest rates limits kind of people who are on the edge, maybe people who are in a home and kind of passively shopping, which drives down resale inventory and incentivizes new buying for the folks that aren't going to have that resale able to purchase. So I almost wonder how much of that is driving this as well. Plus the kind of the fall off in material costs compared to a few years ago, right? I mean, I built a detached garage a couple of years ago, and I probably could have built 2 of them with the way that material prices have fallen since I built it, right? I mean, crazy.
Yeah, I mean, I think, that last point in particular, I think in aggregate, if you talk to builders, they would say their costs are still going up for sure, but certainly on the framing side, right, for sure, wood products prices are down. I'd have to look at it on a percentage basis, but something like, 70, 80% off the peak of the market, right? If you want to look at it in 2021 and 2022. But I think that deceleration in cost inflation is helping them find room and margin to sort of clear the market with these rate buy downs, because that is basically cash out of their pocket still. And they have historic margins, so they have room to pull those down. And certainly that tight resale market is really helping the new home construction side, right? If you kind of look at resale versus new home sales are really taking share of the market. And it's kind of just because it's actually cheaper if you're financing to buy a new home. It's kind of like the used versus new car market. It's cheaper to buy new if you're financing than used for a comparable used home. So I don't think that's a permanent equilibrium. That does, that's going to work itself through. But that is kind of, it's in some ways it has been a tailwind for new construction right now. So,
Dustin, on the show last year when you first came on, you kind of surprised us with the amount of demand that you attributed to repair and remodeling, because we tend to focus on single family housing starts a lot, but a lot of it is that repair and remodeling. Has that changed? I think I remember a number of something like 40% of demand you attributed to the R&R sector. Has that changed since then?
Not much. I mean, it's still around 40%. What has happened is at the outset of COVID, everyone's stuck at home. We know the story with, stimulus checks in hand and people not participating in the service side. We did see a jump in the share of repair and remodeling driven demand for lumber and other wood products. That has kind of corrected down. So I'd have to go look at the numbers, but I think it jumped from 41 to say 44, 45% of demand. And now we're kind of coming back down to those low 40 levels. And some of that is just a reflection of people are back participating in the service side of the economy. Some of that, those decks and those sheds and those fences, that activity was pulled forward into 2020 to 2021. There's only, once you build those, there's only so many, it's only so many years before those improvements depreciate, right? So we are kind of we've kind of cannibalized demand a little bit in 2022, 2023. The repair and remodeling side, it seems to have bottomed out, especially from the smaller, medium-sized projects that homeowners are taking on. But it still is a big share of the market overall. I think the last piece of color is, the smaller, medium-sized projects have really come off, but it does seem like people are still taking on those big, major renovations, $50,000 and above. I think that the backlog is starting to roll off, and some of that is a rate story. People who do finance with, cash out refinancing or HELOCs to finance those home improvements. But also just the labor market is slowing too, to some degree. And a lot of R&R is driven just by, sort of month-to-month savings. And so I think that's contributing to the slowdown too. So
right.
It's spotty, right? I mean, because like the trades aren't homogenous. Like at least in my area of the country, that's true in pretty much everywhere but concrete. And it's just, I think with some of the infrastructure spending that's going on and some of the local municipalities that have gotten some funding, it's been a favorable climate for bond and levy issues. It's near impossible to get residential concrete scheduled at the moment. In my part of the world.
Well, and I think too, the other thing is, and it is a smaller part of the market, but the multifamily side, we saw starts really jump off a cliff here in August, although I think we have to take it with a grain of salt. There's been some huge revisions in the following months, but there's just a massive backlog on the multifamily side. I mean, you look at the construction put in place, even though the starts are rolling over, we still have, a historic amount of multifamily under construction at the moment. And I think, you mentioned the non-res side, non-residential side. I think between multifamily and non-res, I think that is helping support the construction side, even though, single family has really taken a big hit the last 12 to 18 months. So,
yeah.
Dustin, looking regionally, we see some pretty good flatbed demand in 3 regions, right? So we see pretty solid demand out of Quebec, northern Maine. We see a lot in the southeast, where about 63% of single-family homes are started each month. And we see another pocket up in the Pacific Northwest, mainly in Portland, Medford. Can you speak to some of the Sawmill inventory levels and some of the headwinds they face in terms of producing loads?
Yeah, and that makes total sense to geography, because those are 3 of the, let's say, 4 or 5 big producing regions of softwood, dimensional lumber, and also other wood products like OSB plywood. Engineered wood products, things like that. The way we see the situation, we don't see it so much at a regional level. Random Lengths does have a nice little monthly survey that they do that does show, but it's more on the dealer side for regional inventories. What we do see at a more macro level, we'll call it at the U.S. and Canadian level for mill inventories, they are somewhat high right now. So I think when you look at it, for those who are following the lumber market, prices have really still been in the doldrums. Although they're still above sort of pre-pandemic levels, they're really pressing on production costs for the high-cost suppliers, which is really in Canada and the Pacific Northwest. So they're in a tough spot right now because prices are not favorable. They're pressing on the cash cost curve, but they do have these high inventory levels relative to the demand. So I would say in the U.S. and Canada, there's still inventory that needs to be worked off. So to some extent, that's probably supporting the shipment side of the market. We see that in the data as well. But mills are curtailing to some extent to try to balance, their supply with still a suppressed demand environment.
Right. And of course, that leads into their winter period, right? Which is when they normally start to ramp up production to restock inventories. So that doesn't bode well for winter level shipments. Would that be a fair assessment?
Yeah, usually what happens is, they'll have, I'd have to go look at the data, but I think it's usually around December, you do see things kind of ramp up a bit. Part of it is logging. The mills typically deplete log decks into the end of the year. Once kind of the ground freezes, that's kind of prime logging sort of conditions. So mills will start to sort of stock log decks. And then, usually from say December into January, you do see production start to ramp up seasonally again to prepare for the spring building season. So, so we'll see. To your point, if they still have this inventory heading into sort of December, January, you could see some prolonged curtailments in the market for mill curtailments as they just kind of try to work off that existing inventory.
Right. You mentioned at the start of the show other commodities that Fast Markets is involved in. Are there any other sort of topical markets that you could talk about that relate to flatbed demand specifically?
Well, it's outside of the wood products and housing realm is probably I would be hesitant to speak too much there, but I have to think that there's probably we touched on it a little bit. I think one thing that is interesting and it has to be affecting sort of maybe the rebar market and sort of the long steel market is this boom in non-residential construction. Especially look at all the manufacturing facilities that are coming up. It's quite I think what's interesting, and I haven't looked at these markets, so I don't, take what I say with a grain of salt because it's not my expertise area. But I do think what's happening in the U.S. is quite interesting, especially for implications for steel, rebar, things like this, because it feels like the rest of the world is in this in the doldrums. As challenging as things are with inflation and high interest rates, the U.S. economy is actually quite strong, and I think some of what's keeping the cyclical sides of the market supported is this, the infrastructure bill and the non-residential construction boom. So I have to think for steel markets, although the global market is probably in the doldrums, there's probably still good volumes moving through those markets. But like you said, I know you said the flatbed market is still really challenged. So maybe not enough to kind of keep things afloat if single family is really weak right now. So.
Hey, Dean, we have a question from a listener.
Yeah, and I'm not sure, Dustin touched on it, but one of the questions we've got from our listeners, Dustin, is could we expect the renovation and repair market to increase where new house prices are high and consumers lean more towards the fixer-uppers?
Yeah, I think I think that is a tailwind for repair and remodeling, right? Like we're pretty bullish on that market because we think generally there's going to be low resale inventory going forward. I think where we're at is quite extreme. We'll have some correction. I think we're starting to see some green shoots of a inventory correction in the resale market. But I think if you look at the secular trend pre-pandemic, resale inventory was declining, and the new side of the market was sort of continually gaining share. So I do think there's something to that, right? Like there's people are, I think during COVID, especially when rates were low and they had stimulus checks. I mean, and I'm sure all of us could talk anecdotally about fixer-uppers that sold for prices that we would have said, pre-pandemic, how did that sell for that price? But I think, what happened was obviously people had a little bit extra cash in their pocket. And then obviously with rates very low, they were able to take out, HELOCs or finance some of that. I still do think the thing that is a headwind for people tapping into home equity right now is those very high interest rates. If you have a 7-8% or higher HELOC, you have some of that pent up equity that is maybe locked in. Despite the building material side correcting, it is still very expensive to take on a renovation. And, to Ken's point, contractors are tough to track down. So they command a huge margin. And I think there's probably between disposable income sort of slowing down a little bit in aggregate and still the cost of sort of renovations and the financing side being high, there's probably some headwinds ahead. But I think longer term, that point, I think is going to drive the repair and remodeling market. People are going to be more open to these renovations as that's kind of like between that and maybe buying new, that those are kind of the path of least resistance to home ownership and improving your, enhancing your living space, I guess.
Right. One last question, Ken. I wanted to throw out to Dustin. The British Columbia market had a lot of impact from fires, and maybe neighbouring provinces. How much has that affected the supply of inventory this year?
It's interesting. Canada as a whole has had a record-breaking year in terms of total acreage burn. And although British Columbia more recently, that's been kind of the, pun intended, the hot zone for wildfires. It's actually, when you look at Alberta and Quebec, That's where it's been the most unusual in terms of the wildfire impacts. I think Quebec, if you went back to June, July, there was just a devastating sort of wildfire season, which was unprecedented. Alberta had a pretty bad wildfire season. What we did see, what we do see is, when we have these evacuations in affected areas, you do see mill disruptions in terms of, sort of shutdowns. Surprisingly, there really hasn't been that big of an impact. Our data is a little bit lagged in terms of production. We did see a drop off in production in Quebec in June on a seasonally adjusted basis, and that does seem to be a reflection of the wildfires. But really, actually, to be honest, to gauge the impact on supply, we look at the transportation market, and really where we do see the disruptions happen most is particularly if rail disruptions occur, and you have these key bottlenecks. So if wildfire runs over a key rail route, most lumber and wood products from Canada comes to the U.S. via rail. And that's where the bottlenecks and the supply shocks happen. And we really haven't seen much of that. So it's been, despite a record-breaking, and we're still running, we're still in wildfire season technically. We've still got a few more weeks here until the end of September. It surprisingly hasn't really done much to the market. And I mean, part of it too is demand is suppressed, right? So even if there has been some impact on the margin, there's still so much spare capacity out there that they can fill existing demand needs. So,
yep. Okay.
Any plugs, Dean, to bring us home?
Yeah, a couple today. Sales chatter tomorrow, 11 a.m. Eastern with Dan Deegan. Our day-to-day Wednesdays on. I'll be on with him. Landline now, as always. Robert Rouse is on Sirius XM channel 146 Road Dog Radio. I'll be in Tulsa this week at the Oklahoma Trucking Association, and then next week at the JOC Inland Conference, and then of course the Freight Fest conference in Houston at the end of next week. On the current edition of Freightvine podcast with Chris Kaplis, he's talking to Kelly Abney, Chief Logistics Officer at the United States Postal Services. Don't forget DATCon, October 10 to 12. And on next week's show, we've got Chad Kennedy, our very own Chad Kennedy, talking about DAT IQ's new benchmarking product. Back to you, Ken, to wrap up the show.
All right. Thanks for joining us, Dustin. How can folks get in touch with you to read your commentary, analysis, ask questions?
Sure. You can always email me at djalbert, so DJALBERT at fastmarkets.com. Feel free to reach out and happy to sort of field any questions.
All right. So we're going to wrap up. Just to echo what Dean said, all eyes on DATCon coming up in a few weeks here. It's October 10th through 12th. I believe if you still use the discount code GOBUCKS, all caps, GOBUCKS, I think you get something like 25% off. We do still have some space. It's going to be a great event. Shippers, carriers, brokers. We've had some wonderful folks coming to help speak and engage with our customers and users. So it should be a great event. Greatly looking forward to it. So I encourage you to sign up if you haven't already. That being said, we'll be here next Tuesday at 10 a.m. Eastern. We encourage everyone to have a safe week, and we will see you then. Bye, everyone.
Bye.
Through the course of these next 2 days, there's no better chance for us to get your input and answer your questions in one really great collaborative event.
We have so much innovation going on and so much investment, so I can't wait to share this. This is exciting. We're using AI and machine learning and intelligence so you get action right away.
It's about bringing together all aspects of the network to solve your problems.
And we know that you all move faster if you provide that connected experiences for you.
We are trying to make it easier for you to use our products. It's going to continue in 23, and this is a testament to that. With 2 million trucks in our app, all of the stuff in the network, all of the knowledge in this room, we can legitimately change this industry.